Another gold major has reported their first quarter financial results. And you guessed it, the jump in the price of gold has translated to great returns for the major. Of course, we're referring to Agnico Eagle, who is just barely the second largest gold producer by market cap, despite producing about half of what Newmont produces. Production efficiency is key here, and Agnico has delivered yet again. Let's dive in. Agnico Eagle in the first quarter of 2025 recorded top-line revenue of $2.5 billion, which was a 35% improvement year over year from the $1.8 billion recorded in the first quarter of last year, and an 11% improvement from the $2.2 billion reported in the fourth quarter. The figure also beat analyst estimates, which had called for top-line revenue of $2.4 billion. That revenue improvement was off the back of gold sales of 843,000 ounces at an average realized price of $28.91 an ounce, as compared to sales in Q1 last year of 879,000 ounces at an average price of $20.62 an ounce. Net income improved from $347 million, or 70 cents per share last year, to $815 million, or $1.62 a share this year. The figure also improved on a sequential basis, with net income up from the $509 million figure, or $1.02 per share, recorded in the fourth quarter. On an adjusted basis, net income improved from $377 million, or 76 cents per share, to $770 million, or $1.53 per share. Analysts had called for earnings of $1.26 per share, which Agnico beat by about 21%. EBITDA, meanwhile, improved from $883 million to $1.6 billion, while adjusted EBITDA moved from $929 million to $1.6 billion. Cash provided from operating activities totaled out at $1 billion, an improvement from $783 million in Q1 2024, but the figure actually declined from $1.1 billion in the fourth quarter. Free cash flow, however, was up both quarter over quarter and year over year, coming in at $594 million, as compared to $396 million a year ago and $570 million in the prior quarter. On a per-share basis, free cash flow improved from 79 cents to $1.18 a share. Looking at the balance sheet, cash and cash equivalents improved by $212 million to $1.1 billion, which led to Agnico's net debt position dropping from $217 million to just $5 million. Total debt currently sits at $1.1 billion. This rise is despite Agnico spending $50 million during the quarter on share buybacks, repurchasing 488,000 common shares, as well as a declaration of a 40-cent dividend. Agnico also indicated that they intend to seek approval to renew their normal course issuer bid with the intent on repurchasing $1 billion in common shares. Okay, let's take a look at the production data. This is where Agnico really shines compared to their peers. Production in the first quarter totaled 874,000 ounces, which was down slightly year over year from 879,000 ounces, but up from 847,000 ounces in the fourth quarter. Canadian Malarctic, of course, was the big producer in Q1, producing 160,000 ounces of gold, followed by Detour Lake at 153,000 ounces and Meadowbank at 140,000 ounces. Those ounces were produced at a cash cost of just $903 an ounce, an increase of literally $2 an ounce year over year from $901 per ounce. AISC, meanwhile, actually declined year over year, dropping from $1190 to $1183 per ounce, which quite frankly is incredible, given that 5,000 fewer ounces were produced year over year while the average realized price of gold increased 40%. Yes, despite royalty costs rising because of the rising price of gold, Agnico has managed to cut their all-in sustaining costs somehow. But a weak Canadian dollar certainly helps when gold is sold in US dollars and mined in Canadian dollars. Agnico also credited lower sustaining capital expenditures for the decline as a result of lower deferred development costs at Detour Lake. Cash costs were also down quarter over quarter, from $923 an ounce, while AISC declined from $1316 an ounce in Q4. For comparison purposes, Newmont earlier this week saw their all-in sustaining costs increase by $188 quarter over quarter to $1651 an ounce. Full year guidance at Agnico remains unchanged, which calls for 2025 production of 3.3 to 3.5 million ounces, at cash costs between $915 and $965 an ounce, at an all-in sustaining cost between $1,250 and $1,300 an ounce. And finally, like any good mine operator, Agnico Eagle provided some insights into their various operations as part of their first quarter financial results. At Canadian Malarctic, Agnico continues to work towards the transition to underground mining with construction of the Odyssey mine proceeding on schedule. The company is currently analyzing methods of increasing annual production from the mine to 1 million ounces a year in the 2030s, with potential methods to include a second shaft at Odyssey, the development of Wasamac, and the development of a satellite deposit at Marbin. At Detour Lake, construction of temporary infrastructure has continued for the underground project, while the contractor for the construction of the ramp has begun to mobilize. At Upper Beaver, installation of structural steel for an exploration shaft headframe has begun, with sinking of the shaft on schedule to begin in the fourth quarter. Well, progress on a feasibility study for the San Nicolas Copper Project continued to advance, with that study due out in the second half of this year. Finally, at Hope Bay, site preparation for the excavation of the Nartok East exploration ramp was completed. Excavation of the ramp has reached 203 meters of a planned 2.1 kilometers, which will be used for the infill and expansion drilling of the Madrid zone. Agnico also begun dismantling the existing mill as part of a plan for a new processing circuit that is being contemplated in the technical evaluation. All right, so let's wrap it up. Agnico Eagle had another great quarter, and their cost profile is really second to none, at least among majors. That profile is what allows them to trade at such a high multiple relative to Newmont and other peers. And honestly, it also serves to provide some much needed positive sentiment to the space, which we can always use more of. But with guidance calling for quite a bit higher AISC on a full year basis, we'll see if they can maintain this low costing for the remainder of the year. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, we are just starting earnings season. If there's names you want us to cover, let us know in the comment section. I promise you, we read them all, and if it makes sense, we're going to get to it. All right, everybody, thanks for watching.